Hi there, welcome back. This is Ron Yaish with BalancedFinancialLife.com. This is our series all about IRAs. More specifically, today we're focusing on Roth IRAs. And in this segment, we're going to be focusing on withdrawals, withdrawal rules, and the Roth IRA. There are a number of questions out there, and we want to try to address as much of those questions as possible. So one of the things that we did mention in our earlier segment all about the Roth IRA is that at 59 and a half, one can take the money out of the Roth IRA and not have to pay any taxes, and there would be no penalties. But there are a couple of things that need to be clarified. There are a couple of things that need to be better understood. So first and foremost, actually, let me just excuse myself. Okay, so we're going to use some numbers to make this example work. Okay, so let's say somebody has $50,000 in their Roth IRA. Okay, and they had contributed $30,000, and $20,000 has, the account went up by $20,000 in returns. So right now the value of that account, the balance in that account is $50,000. Okay, so number one, when it comes to withdrawals, okay, what you could take out, what you could withdraw, you could withdraw the $30,000 that you put into the Roth IRA at any time without penalty and without taxes. Okay, so you have $50,000 in this account. $30,000 is what you put in. $20,000 was the growth of the account. So you could take this $30,000 out at any time and not pay any taxes and not pay any penalty. Okay, it's only if you take out this $20,000 that, depending on the reason why you were taking it out and how you took it out and how much of it you took out, you may have to pay some taxes and penalties if you took it out before the age of 59 and a half. So that's step one. Step two is if you opened up this account, the Roth IRA, from the first time a contribution went into the Roth IRA, there has to be 5 years. Okay? What that means is you could only benefit from the Roth IRA and taking that money out of the Roth IRA after the Roth IRA, from the first time a contribution went in, aged by 5 years. Okay? So theoretically, if somebody was working at age 60 and they made a contribution into their Roth IRA, they couldn't pull the money out penalty-free until 65. And getting the dates, you have to speak with a before taking any action regarding financial matters and such matters. You should seek the guidance of a tax professional and a financial professional, because there are situations, and your situation may be different, and your eligibility and when to pull something out, and whether that time may be extended, or your unique circumstance has to be evaluated. So by no means is this meant to be advice. This is meant to be an educational piece. So before taking action, please seek professional advice. Okay, so the account from that first time has to be 5 years old. So we keep hearing the number 59 and a half, assuming that account has been around. Okay, so you can't, it only works if that account was around for 5 years. So that's the second component, and we'll add some, different points. And the third point that we're going to address today has to do with exceptions and when could you take something out and how does that work, etc. For example, if you're a first-time home buyer, if there are some, college expenses or medical expenses, how does that work? Do I not get penalized, but I do get paid taxes on that 20,000? Remember, our example is you have $50,000 in this Roth IRA, and 30,000 is what you put in, 20,000 is the growth. So we're going to use that as our example. Okay. So the account has to be at least 5 years old and from your first contribution. Okay. So we already went through this. All right. Now we're going to look at qualified distributions. Okay. So as long as somebody waited, the account's been around for 5 years and you waited till after 59 and a half, you could take the money out, including that $20,000 growth, not pay any penalty, and not pay any taxes. A. B, the government, unlike the traditional IRAs and the other retirement accounts where the government tells you at age 70 and a half that you have to start taking money out, with the Roth IRA that we're discussing today, you don't have to ever take money out. So as long after 59 and a half, and then you're in control. It's been around for 5 years. You could let that money grow, and you won't pay taxes or any penalties. Again, as long as that account has met the 5-year rule. Okay, so that's one thing. The other piece is, now there are some qualified distributions that you have to be made aware of. Okay, as long as the account has been around for 5 years, there are other situations that may come to play where somebody may need to take money out of this Roth IRA. So for example, if this individual got injured or something happened and now they have a permanent disability, you could take that money out without paying any penalty or any taxes. The other thing is when it comes to beneficiaries or the estate after somebody passes, again, there wouldn't be a penalty or any taxes paid as long as this account has been around for 5 years. This 5-year rule is pretty dramatic, and most people don't hear about it. The number we keep hearing about is 59 and a half, 59 and a half. But it's 5 years and 59 and a half when it comes to the Roth. And so if somebody was permanently disabled, if there was the beneficiary, because somebody passed away, that money can go to a beneficiary tax-free and penalty-free. And the other qualified distribution is that you would have tax-free and penalty-free is if one decided to take $10,000 lifetime, which is the lifetime maximum, take $10,000 out of the account. Now, I'm not making this recommendation. I actually don't think it's a good idea for many reasons, this piece that I'm about to explain. If one were to take $10,000 out to buy, build, or rebuild their first home, they can do that tax-free and penalty-free out of their Roth IRA. Now, obviously, I'm making that blanket statement. I don't know your situation. That's why we always recommend that one seek the advice of a financial and or a tax professional. But I'm not a fan in general of taking money out of IRAs prematurely. I just find that it's too easy, and it winds up you wind up abusing your future for a benefit today. And that's kind of the way that I see it. And sometimes you have no choice, and people are in a tough spot, and they have debt, and they have a lot of things that they have to manage. So I'm not judging. I'm just saying, what is the best practice? Excuse me. Oh, I'm so sorry. Sorry for clearing my throat. It's so rude. But for some reason, I'm having a hard time. Okay. By the way, the R is for Ron. Okay. So let's get back to our discussion. Okay. So we first discussed how a withdrawal would be okay with a Roth IRA as far as 59.5, 5 years. Then we went into what a qualified distribution is, okay? And we discussed one who may have a permanent disability or after death when an estate or a beneficiary takes over, that would be tax-free and penalty-free. And then the one I'm not so excited to discuss, which is taking the $10,000 lifetime withdrawal, which is a qualified distribution. But then there are non-qualified distributions. Now, what that means is that in some situations, you wouldn't have to pay the penalty, but you would need to pay the taxes on that $20,000, right? Because we're looking at $50,000, okay? So $3,000 of that is money that you put in, and $2,000 is the growth. So when you're looking at these the 3,000, I mean 50,000, right? So it's 30,000 and 20,000. So on this 20,000, there are situations that you wouldn't have to pay a penalty. And again, things change, things evolve. Today, this is 2019. Okay, so in a situation where somebody has major medical expenses, and there's a criteria that those medical expenses are exceeding 10% of their adjusted gross income, that money that is taken out of the Roth IRA, although may need to be taxed, wouldn't have that 10% penalty. As well as if somebody lost their job and they're paying medical insurance premiums, or there's money that is owed the IRS. There are a number of examples like that for qualified disaster recovery. These are not easy things to manage, but the government's saying, look, if you're in a bind, and it's not any bind, and who defines that bind is the government, right? But if you fit into that rubric, and I will include a link to a list of what that is, so that you can get an idea of that. And if you can't find a link here, you can always come back to our website, balancefinanciallife.com, where we'll post that together with this, because this winds up getting. This is now, being shown to you, but they don't always make it so simple to put it into the notes below, or put it into where you push the arrow down and you kind of can see some notes. So we'll try to include a list of those exceptions where the 10% penalty would not be levied. Okay, what else? Make sure that we covered everything else. Okay, and then there's college. So the other piece of this is that you could take money out of your Roth IRA. Again, I don't recommend this. Because, we're seeing an easy fix for something today. And again, I'm not judging, and I don't know your situation, but maybe you're trying to accomplish something that is beyond your means. And I raise that because if you're already having to tap into monies that you put away for a different purpose like retirement, that should be something to consider and to look at very carefully. So for example, Um, one of the one of the one of the allowed distributions, withdrawals, that would be penalty free from a Roth IRA would be for higher education expenses. So things like tuition, fees, books, supplies, different types of equipment, and room and board. As long as you're at least a half-time student, you can't be somebody that's just showing up once in a while, then you could take that money out. So for example, if you had that example, right, so we're working with $50,000. So if part of that, you took out the whole thing to pay for higher education. So now you took out $20,000. Wonderful. You're not going to pay the penalty, right? Penalty on $20,000 is $2,000. So that would be 10%. But the government says, whoa, 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 whoa. You would still owe us income tax on that earning, on that $20,000. So whatever the bracket is, you would have to pay, and that would be fine. Okay. Now, because this is an important thing to know, because the Roth IRA withdrawals count as income on FAFSA, that may impact financial aid. Now, that's a whole separate discussion, and we'll have to address that separately. There are, experts in FAFSA and college planning and in student aid advice, and I like to turn to those experts and get their advice and get their feedback. And some of that has to do with, again, beyond the scope today, some of that has to do with when you take the money out. Depending on what year this is happening, and sometimes there's a 2-year look back, so it may benefit somebody to take some of that money out in year 3 and 4 because the 2-year look back would impact that. So that's an important factor, right? So that, this money taken out to use for these types of examples, such as education, that would be income, and that may impact, right? Because depending on how much income you're making that year, your FAFSA application, which is what you have to apply for to figure out how much financial aid and what your situation is going to be regarding, loans or grants. It's basically, FAFSA stands for Free Application for Student Aid, right? So students I'm actually going through this right now with a member of my family who is applying to college. We are actually, we were supposed to do it actually yesterday to fill out our FAFSA application, because you never know. And it's part of the process. And okay. And I think that's basically it. Again, I know everybody's in a different type of situation. I just want to clarify that I'm not judging anybody. I don't want anybody to feel bad. If you have to tap into retirement savings, then you need to do it. And, I'm not here to judge, but I'm just saying that if you're already doing that, it means something else may be awry. Are you considering everything? And then what happens in the future, right? It takes time. It takes some money to build a certain amount of wealth that will sustain you in retirement. And that's the purpose of a Roth IRA. That's the purpose of a 401k, different retirement vehicles, to get you to that point where you have some different means to tap into beyond your Social Security income. Okay. I think that is basically it. So let me know if you have any questions. This is Ron Yaish with balancedfinanciallife.com. Please give us your questions, your examples, your situations. Everybody's got different opinions. We want to hear what you have to say. Share it down below. And if you wanted to ask your own question, you wanted us to address it here, we do have a series that we do called Ask Ron. You can go to our website. I don't know what that was. Balancedfinanciallife.com. I believe on almost every page there's a section that is labeled Ask Ron. You could put in a question. You could choose to put your name, or you can keep yourself anonymous. You can put your email address. If you do put your email address, we do try to respond back to you. So in addition to posting this and sharing this abroad, obviously you don't want to make it a personal kind of question because that's beyond the scope of what that would be okay for. But if you had a question, and you included your personal information like your email address, we would, send you that which you asked for. We do our best to do that. But otherwise, just, respond back here. We see ourselves as a community of financial and money education. That is what we hope to strive to be. We want to be there for you. Our purpose of being balanced is I don't really believe that there is a one-size-fits-all, and that's what we strive to accomplish. So pleasure sharing some time with you, and till the next time, take care. Bye-bye.